Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part two of our interview with money manager Michael Pinto. How has your portfolio fared on a relative basis?
So this year we're down low single digits. And the reason for that is because three of the four horsemen of the economic apocalypse are working: dollars, shorts, and cash. Bonds that we own, we no longer own long duration treasuries. We'll probably get back in that trade.
The Japan one, I guess that ends. we know it at least ends when they run out of treasuries to sell. They're probably not going to run to zero. Do you see that selling abating anytime in the near future?
If they continue to try to support their yen by dumping their currency reserves, that's going to just lead to a big problem down the road. So it's limited in duration for sure. They have to eventually they're going to have to decide, do they want their currency to get wiped out anyway, or just raise that level, that cap at a quarter of 1% on their duration bonds. And that if they were to do that, that would drag up yields across the world. That's not going to be positive for treasuries in the short run either. So you have to watch, that's why I say you have to be there every day watching when is the good entry point for long duration bonds. It's going to be tricky, but I think it's coming.
Capital around the rest of the world is getting pretty abused right now, and they're likely to still have the lumps that we take here in the US, they're still likely going to take worse than we.
Yep.
And so, if things really start getting rickety, so that capital is going to be moving into US markets in general, just trying to find, better treatment. But if we get something that forces a Fed pivot, on the way there, capital is going to increasingly be looking just for safety, right? And the US Treasury is still, the safest asset around in most people's minds. So I can just think of all these different vectors for why capital is going to flow into the Treasury. And of course, if there is a Fed pivot, then there's a whole bunch of people that are going to want to play that, right? Which is, US Treasury, rates are going to come down, the prices should go up. So let's, jump into the long end of the curve here.
Yep.
So, I'd love your reaction to this.
Yeah, I agree with everything you just said. I mean, your calculation goes like this. Should I lose 30% of my principal and going out to try to buy stocks, go buy, or Bitcoin, use 30% of my principal and then subtract 8% inflation? Or should I make 4% in a risk-free short-term treasury and only lose 4% in real terms?
Yeah, and sorry to interrupt, Michael, but not only are you getting paid that 4% that you just mentioned, but you have the option value that if interest rates, drop in a pivot or because tons of capital is coming in a crisis, that your bond could appreciate dramatically. I mean, if we get a real pivot where Powell drives rates back down to 2%, 1%, even lower, on the long duration bonds, you could see 20, 30, 40% appreciation, right?
Because the convexity, you go out, long duration bonds perform great. And if on the short duration bonds, if you're still going to if you buy a 3-month treasury and he's going to zero, you're going to, you'll see those prices appreciate and you're still going to collect a higher yield there. So, but most of your juice will be out along the yield curve, zeros and TLT.
Okay. So just to sort of put a bow around this, bonds, particularly sovereign bonds, there's different issues with corporate and muni bonds. And if you have anything you want to say about those, Michael, please do. But it sounds like what you're saying is the planets are beginning to align around sovereign bonds. It's just a matter of finding the right entry point here. And I guess we'll say you're watching things closely right now.
Absolutely. And, the predicate for every asset class, sector, and style factor in each of my 5 sectors of between disinflation, deflation, recession, and stagflation, hyperinflation, intractable inflation is backtesting. And you look at the backtest every single time we had a global slowdown, the primary beneficiary is the dollar. And it's just a reversal, an unwind of a carry trade, basically. People borrow dollars, lower yielding debt, and they go out and they speculate in, Brazil and China and Russia and India. And then when the recession comes, they have to unwind that carry trade. They got to sell their assets there, sell their current local currency, and buy back dollars to close out the trade.
But you talk about the 4 horsemen of the apocalypse. We really dialed into bonds this time around. But the other components of that are being long the dollar, holding a lot of cash, obviously, and then being short. Is there anything you want to say about those other 3 components?
You notice a couple of days ago, you had a 10% rally in the miners. And that was followed by another 6% rally because we're getting there. It's sort of like a washout period here for the gold miners. And I've avoided the big plunge in these in particular, these miners, this asset class. But I'm thinking about and getting ready to buy them because I do think you're going to get to a plateau. And even if you get just a plateau in interest rates, these miners could be a buy. So I'm looking at that now.
What signs will you be monitoring to signal that it's time to start switching from defense to offense? So let's say we are now into the first quarter or two of next year. Things are unfolding the way that you think they're going to. What are you going to be looking to say, okay, it's time to start getting back into the pool? You just gave us a good one for the gold mining complex. What other ones would you be looking for?
So I got 20 components to my model. I'll be looking at credit spreads. I'll be looking at that 10 to treasury spread. First of all, the bulls come back and buy short-term treasury. So the spread might initially increase, as it usually always does, but that's your signal that, hey, the meat and the teeth of the recession is happening now. Powell is indeed either pivoting or about to pivot when you see that happening, and that'll be presaged by, you'll see a massive flush of money coming into the short-term treasury complex.
Okay, so sorry to interrupt, but you'll want to see those spreads widen or blow out.
They always do,
but largely less because the high yield debt yields are going up, but more because the government debts yields are going down because of all the capital going in there.
I think they call that a bull steepener.
Bull steepener. Okay.
You see people run into the short-term treasury complex. That's a big clue. Financial conditions index will, instead of rising, will start to come down. Like I said, I'm going to sit here and go over all 20 components of my model. The dollar is another signal that I use. The real Fed funds rate is another thing I use. So
when it looks to you like the coast is clear, are there any particular assets that you're excited to start buying again? You mentioned gold miners, you mentioned dividend paying value stocks. Are there any other sectors or assets out there that you are excited to buy when the valuations are good?
I probably wouldn't be very excited to buy defense related stocks too. Because I'm worried about what's going to happen now that Emperor Xi Jinping has strengthened his grip over China and what's going to happen with Taiwan. I think defense stocks could be a great play. You do get a dividend there too, but you also have a little bit of safety in case we do, God forbid, go to war.
Okay.
So, by the way, that doesn't actually contradict owning gold either. So you see where I'm heading. Just not the time yet, but you see where I'm heading. So gold and defense and some dividends would be wonderful, but not now and not at these prices.
Okay, so we'll have you back on this channel as often as you want to come back on, Michael. So we'll be able to let you make those audible calls if and as you see these opportunities begin to arise.
So I just want to say this, that Adam, not only do we have the most hawkish Federal Reserve in the history of the institution, but you had never before had in your life 3 concurrent asset bubbles, so happening at the same time. You had equities that were 210% of GDP at their high. Okay, never before even imagined to go that high. You had a bubble in equities. You had a bubble in bonds where you had junk bonds trading several hundred basis points lower than what treasuries have historically offered. And you had homes, real estate. The home price to income ratio was much higher in 2022, the summer of 2022, just passed, than it was in November of 2005, the previous peak. Mm-hmm. So you have, that's why when people say, it's going to be a mild recession, there are no excesses. Well, outside of the bond, equity, and real estate bubbles that were at massive proportions, outside of that, there were no, over leveraged conditions in the system. Outside of those 3 most important asset classes that exist. And as you mentioned before, just to underscore, corporate debt as a percentage of GDP, 50%, all-time record high, $10 trillion. Non-financial business debt, record high. There's $3 trillion more of household debt as compared to what was in 2018. Okay, so even though it's down a little bit as a relationship to the economy, historically, household debt to GDP is still very high. And of course, the nation's debt as a percentage of the economy, both in nominal terms and a percentage of the economy, is at an all-time high. Is it $32 trillion national debt? So, and people say, oh, well, don't worry, it's the government's debt. We don't have to worry. Well, the government doesn't have any money. They have to sell that debt to us now that the Fed isn't buying it anymore.
Isn't buying, yeah.
So yet all these things point to the most massive over-leveraged triumvirate of bubbles we've ever had. We still have a hawkish Fed. So please don't misunderstand what I've said so far. I'm saying that I'm not a perma bear, but we still have a lot of downside yet to come, in my opinion.